Who is the greatest investor of all time? Buffett versus Lynch? Find out now. In this video, we will tackle with one of the most interesting questions in investment. Who is better, Warren Buffett or Peter Lynch? So stay tuned. Also, before we continue, I will request you to subscribe to the channel. Subscription is an excellent way of supporting the channel. I am very grateful for all the support you send my way. Warren Buffett, also called the Oracle of Omaha. Warren Buffett is one of the most successful investors of all time. He runs Berkshire Hathaway, which owns dozens of companies, including insurer Geico, battery maker Duracell, and the famous restaurant chain Dairy Queen. He has also promised to give away 99% of his income to charity and asked his fellow billionaire philanthropists to do the same. Peter Lynch. Peter Lynch is a highly successful stock picker. Lynch is the legendary former manager of the Magellan Fund at the major investment brokerage Fidelity. He took over the fund in 1977 at age 33 and ran it for 13 years. His success allowed him to retire in 1990 at age 46. His investment style has been described as eclectic and widely suited to the prevailing economic environment at the time. However, Lynch always stressed that you should be able to understand what you own. So who's the better of the two? Investing style. To answer that question, we must understand how Peter Lynch invested versus how Warren Buffett has invested throughout the course of their investing career. Peter Lynch, in his book, One Up in Wall Street, explains that he saw different stocks in different categories. He painstakingly lists these categories as slow growers, stalwarts, cyclicals, fast growers, turnarounds, and asset plays. Slow growers are older companies which are growing slightly more than the GDP. These companies are valued for their paybacks and dividends. Then there are the stalwarts, which are large holding companies and where profits are increasing slightly more than slow growers. Cyclicals are companies whose profits and losses are increasing and decreasing in regular patterns. Although it has to be said that these highs and lows cannot be predicted with a complete accuracy. Fast growers are stocks which are expanding at a very rapid pace, up to 25% per year. Turnarounds are companies which are at the edge of bankruptcy and their market performance cannot be related to the way the broad market is operating. Asset plays have not been completely appreciated by the market and their value has been overlooked so far. It has to be said that the Peter Lynch sees these companies as completely unprecedented. Most fund managers have a very rigid investing methodology. They usually are looking for companies with large cap growth or companies which are deemed to have a fixed growth or are considered safe bets. This investing style goes not only against Warren Buffett's investing methodology, but almost every hedge fund investor. Warren Buffett only relied on his circle of competence and did not invest beyond the conventional circles of banking, insurance, media, and consumer non-durables. Stock holdings. In terms of stocks, while Lynch was quite comfortable investing in different stocks at different times, Buffett has a few concentrated investments and has never really invested beyond a few comfortable holdings. Buffett has invested based on the reputation of the companies, size of the companies, and market fluctuation. Explanation of investment performance through factor analysis. Now, when we try to evaluate the market performance of Warren Buffett, we see that his investment performance dominated the market by more than 10% per year, all the way from January 1977 to May 2016. Buffett also has a Sharpe ratio of 0.74, which shows that returns adjusted to risks was quite impressive. But a systematic factor analysis, which has already been conducted by established market commenters Dan Villalon and Jordan Brooks, shows that most of Buffett's success can be explained away by several factors, including U.S. equity market factor, market value, low risk, and quality. In terms of factor analysis, the 10.6% outstanding dominance over the market can be overwhelmingly explained by systematic factors. This means that while Buffett was a really astute stock investor and had a pulse over market dynamics, there is nothing anomalous about his stock-picking behavior. As compared to Buffett, Peter Lynch annual performance was 13.7% more than the market and a Sharpe ratio of 0.98, which again shows that the stock-adjusted returns are more impressive than Buffett's. Now, when we render Lynch's performance factors on a systematic index, we find that his approach takes into consideration more factors than Buffett's approach to investing. These factors include equity of the U.S. market, size, quality, momentum, value, and low risk. Now, this is the most surprising thing about Lynch's modus operandi. Even after being exposed to more systematic factors, only 5.4% of his stock picking can be explained by these factors. This means a larger chunk of his decisions, which is approximately 8%, remains unexplained. This means that there was a special factor in the whole Lynch investing calculus, which makes him a standout and a better investor than Warren Buffett. Concluding statistics. Aside from boring factor analysis, raw figures also support our contention that Lynch is the better investor. For instance, between 1977 to 1990, in the 13 years when Lynch was head manager at Magellan Funds, he was able to multiply its wealth 29 times. Warren Buffett was only able to multiply the wealth by 23 times of Berkshire during the same time. This can also be seen as a return of 2,800% of Lynch as compared to 2,300% of Buffett's during their overall tenure. So the answer is Peter Lynch is the overall better investor. I hope you enjoyed today's video. Please hit the like button and see you in the next one.